We're good to go. Okay, the button works. Okay, excellent. So hi everyone, my name's Louis Hems. I'm a commercial director at the Dubai Gold and Commodities Exchange. It's really good to be here, and I'm really delighted to see so many people hanging back for the final session. We won't keep you too long, I'm sure. There's some rumbling bellies for lunch, but we are going to have an amazing final panel to end the 3 days we've had here at the AFCM. Such a great conference, so good to be here for my first time as well in Qatar, so thank you very much. So let me just give a quick introduction to the panelists. We've got some excellent experience and different views from the panelists that we're going to get today. So let me just give a brief introduction to each of you. So we've got Dr. Sameh, he's CEO of Evolve Investment Holding, with over 40 years experience and some really interesting insights in the Egyptian gold market that he'll be able to share with us. We've got Serge Marston, he's MD, Head of EMEA Sales at CME Group, looking after sales, promotion and distribution of their broad range of products into banks, asset managers, corporates, HFTs and beyond. He's a former banker at Deutsche Bank and formerly an MD at NEX, so excellent experience for us there. Lee Beswick is our next panelist. So he's VP Investment Group Asset Management, at Qatar National Bank. And then last but not least, right down at the end, Andrew Naylor is Head of Middle East Policy at the World Gold Council and comes to us with long experience in consultancy and policy advisory. So we've got a wealth of experience in the panel. We've got some questions that I'll obviously be going through first of all, and then hopefully we can do a bit of Q&A with the audience, which I think would be really good. Before we start going through some questions, I was just thinking it'd be good to observe some observations about the gold market as an interesting asset class. Oh, sorry, I'm speaking a bit quiet. I'll go louder. Gold as an alternative and interesting asset class. So obviously gold tended to be a safe haven investment, particularly during times of uncertainty. And we've got, geopolitical tensions at the moment. We've got rising inflation rates and things like this. So gold typically has been seen to be a safe haven investment, and therefore, prices in gold have risen recently. And we'll be able to reflect on how investors can use that in their investment decisions and their own portfolios. But let's start with one of the questions first of all. So this one's for you, Serge, from the exchange perspective. So beyond traditional asset classes, what is an alternative asset class, and do we even need alternative investments around this space?
Hi there, hope you can hear me. Do we need alternative investments? It's been a long-standing question for decades, but if you take a look at, certainly the past 20, 25 years, long-short equity plays was normally the flavor of the month based on the kind of negative correlation between those asset classes. That worked really well in the 90s and the early noughties, but certainly over the past 5, 6, 7 years, and particularly post-pandemic, that correlation matrix between the equity and fixed income markets has fallen down. So if there's any argument now in terms of the particular investment in alternative asset classes, certainly we've seen on our markets interest in alternatives, and it's manifested itself with that breakdown in correlation in a surge in demand, particularly from buy-side firms in commodity asset classes. So more broadly, and I know this is a precious metals panel, but more broadly across the asset classes in terms of energy, in terms of agricultural products, in terms of precious metals, we've seen a remarkable rise in terms of the adoption of those particular pieces. We're a derivatives exchange, and therefore they don't actually, although they settle in physically settling those particular products, they use the derivative exchange to manage their underlying risk. So we're a pretty good harbinger for the adoption of alternative investment strategies more globally. I will say that certainly from a gold perspective specifically, we have seen a surge. In fact, more recently, we've had a record of volume on our gold contract of 290,000 average daily volume which in fact, if you translate it into actual underlying gold, that's, one contract equals 100 troy ounces. So that's 29 million troy ounces in underlying interest traded on a daily basis. A lot of that has been fueled by investors in a pursuit of this sort of alternative asset class narrative. So I do think that's, I think now the alternative investment narrative is firmly on the agenda.
Perfect, thank you. Question for you, Lee. What could be the main challenges for investors to diversify risk when correlation across stock markets increase due to financial or macroeconomic turmoil, such as we're facing at the moment?
Thanks, Liz, for the question. I think when some of the key points to make there would be, and key points to think about would be diversifying and correlation. So traditionally, when we're looking at an asset allocation model, we typically rely, just as Serge was implying just a minute ago, we've typically looked at stocks and bonds as being negatively correlated assets, which for most people in this room, certainly for the past 20 years, has been a consistent theme between those two asset classes. Actually, if you look back, what I would probably call over a real history, so look back 100 years, we see many times where actually bonds and stocks have been positively correlated for long periods. So one example would be the 1966 to 86 period, which encompassed obviously the breakdown of Bretton Woods and the crisis of the 1970s. We can also go back even further and look at the gold standard from 1933 up to the Second World War. And that was sort of a period of 15 years where stocks and bonds were equally positively correlated. So in an environment where you see stocks and bonds positively correlated, bonds end up being a very poor diversifier to your stock portfolio. And that's where looking at alternatives, and gold is one good example, can actually benefit the investor by providing some proper diversification, which you don't get in times where stocks and bonds are positively correlated. So if we're looking certainly in recent history in the last probably 3 or 4 years, and all of those periods I mentioned in the past, what's the main theme there? It's times where inflation has dominated the economic discourse. If we are in one of those periods again, which it certainly looks like so far, the evidence of the 2020s is we are, where inflation is actually back as an economic consideration, then stocks and bonds become very poor diversifiers for each other. And bonds in particular become a poor diversifier for your stock portfolio. And that's the evidence we've seen, certainly for the past 3 or 4 years, that actually there's a positive correlation now, which means while you're getting growth in your stock portfolio, you're not getting the safe haven characteristics that you used to get in a bond portfolio prior to 2020.
Forgot to press the button. Thank you, Lee. Very clear. Serge, so CME obviously is about diversifying risk. Anything to add to what Lee said on there?
Well, apart from the fact that you have a much better data set than I do in terms of you going further back, no, I would just really echo those broader sentiments. That certainly from what we have actually seen, buy-side firms are firmly adopting a lot of these asset classes. Precious metals is a big part of that particular piece. I would argue also that gold at the moment is playing even a larger role than just a harbinger of geopolitics and even of inflation, but also of investors' view around underlying rate policy, right? And so it's sort of a report card, if you will, on their view and beliefs around rate policy, particularly Fed policy. So I would suggest that, there are broader now factors at play, which make it an even more interesting asset class in order to engage with.
Can I just come in there as well? Just on,
of course. You're quite far away, but I've got you.
Sorry, on gold and the lack of correlations. The lack of correlation that's particularly acute in periods of downturn. You do start seeing slightly positive correlations in pro-cyclical environments, but the reason gold is an effective diversifier and a unique diversifier is really because of the complete uniqueness of the structure of gold demand. There's no other asset class like it. So you have 39% of demand is jewelry, which is very pro-cyclical. 19% is central bank demand, which is a mix of safe haven plus some pro-cyclarity as well. Investment demand tends to be counter-cyclical. Then you have about 7-8% of annual demand is tech. There's no other asset class that has that unique demand profile, and each of those sectors of demand behaves very differently in different economic environments, is very different economic and financial motivations, and that means that gold just performs differently, and really there isn't an asset class like it. I mean, often this panel is about precious metals. You can look at silver, palladium, platinum, very, very different demand profiles. They're more industrial metals. You do get some investment demand in platinum in particular and silver, but they are primarily industrial metals, so they tend to have stronger correlations, and it's gold where you get those lack of correlations and therefore diversification properties.
Okay, thanks, Andrew. I've got one more question for you, Andrew, and then I'll come to you, Sameh, as well, give you a chance to speak. So would you say then, Andrew, does gold exhibit the function of a hedge, diversifier, or a safe haven asset for the capital markets, particularly from a Middle East and Africa perspective?
Yes, I mean, I've just spoken about diversification. That's the same here as it is anywhere else, but because of the currency pegged to the US dollar, that's another dynamic to bear in mind in this region. When it comes to gold as a safe haven asset, that's partly because of its performance, but it's also because of its physical nature. So it's gold in physical form that's a safe haven. When you own it, and you have the beneficial ownership and the title to it, it's yours. There's no credit risk associated with that asset. And so it's a combination of gold's diversification properties. It's safe, and the fact that it's a physical asset without credit risk if you own it outright, plus its performance. So if you look, in the past, since 1971, when we came off the gold standard and the investment gold market really kicked off, average annual returns have been around about 7-8%, which is not bad. So you can benefit from the upside and wealth preservation properties as well, and it's really a combination of all of these different factors. Plus, gold is liquid, over 145 billion trades every day, that makes it such a unique asset class. And so one of the motivations is safe haven, and it's safe haven properties, but it's not the only reason for thinking about an allocation to gold.
Perfect, thank you. Sameh, anything to add to that?
Yes, I agree with Andrew. And also you add that, especially in the Middle East, and especially in the Arab world, gold have been traditionally the safe haven through history. I'm coming from Egypt, so we know from since the pharaohs, so it's very long, 5,000 years or something like that. I think where the challenge is nobody is arguing it's a safe haven. Nobody is arguing it's extremely important to have the gold and the precious metal in general, and we can, like Serge had mentioned about how the stock exchange and how the traders are doing and the investors. I think what we have right to think about now is infrastructure. Is the infrastructure for the capital markets in the region is ready, and the stock exchanges are ready to help investors? Because is the demand there? Yes. If the investors look at the safe haven, yes, they are, and the market I think we have 7 or 10% of, Andrew, you can correct me, in the Middle East through the global there. So I think it's a very important. It's part of the culture, and it's what we need to think about is how we build the infrastructure for it.
Thank you. We had a brief discussion before we were coming to the panel. It'd be great if you could share your experience about tokenization of gold and how you see that going, and give us some perspectives on that.
At the level of Evolve, we looked at the Egyptian market, and we saw that the Egyptian market is big in the gold. However, we didn't see the infrastructure because the gold is dominated through the traders in the souk, and of course they are doing extremely well. But we need to turn it to a financial asset and a digital asset. So when we build the infrastructure, and with the support of the stock exchange, Rami was there in the stock exchange, and Dr. Mohammed Farid in the FRA, and Ahmed Abdurrahman, the players right now with us. We succeed to build the infrastructure with the stock exchange, and we started to do funds. And when we started the funds, nobody thought that we would be able to attract capital to the funds, and it exceeded our expectation. I remember I met with Rami when the first fund was there, and it became the product of the year. And more important was, the bigger surprise for me was our digital platform. Our digital platform, to introduce digital gold in a country where people are used to the physical gold, was a big risk. But what we have seen, and for my surprises, is that our digital trading platform for gold exceeded, we have 2 funds now that we established, exceeded the funds that we established in the capital market. For me, it was very interesting, and we saw that investors are coming. Now we are talking to the regulators to create more products on the digital side. We're talking about contracts, we're talking about securitization of the gold, we're talking about sukuk. So it's this have opened the door for a lot of financial products to come. And I think the future is for the digital gold. I'm a big believer in that. And I think I've seen in India, for example, in China, we look at the digital gold is expanding there. And the markets will surprise you, and the consumer will surprise you how they are ready to product that we think they are not ready for.
Thank you. Andrew, any views from your perspective about these kind of retail gold and digital gold products?
Yeah, I mean, tokenization of gold, digital gold products, we're talking about gold in physical form, but it's been digitalized. So you're creating a digital record of the underlying physical asset, which is linked to a specific bar. This has transformative potential in 3 ways. One is access, because tokenized gold or tokenized assets can be traded on a more diverse range of platforms. So you can get that sort of kind of accessibility increase when you tokenize. But also it changes the target profile of the consumer. So with tokenization, you can also get fractionalization. So the most price-efficient vehicle for gold is usually a large 400-ounce bar. So a bar that trades in the London market, that would be current prices, a lot of money, $600,000-$700,000 a bar. So for most people, that's really outside of their price point. But you can fractionalize that. So you can bring the benefits of that price-efficient vehicle to a wider range of market participants, the retail market. And that's potentially very attractive. But what we're also seeing as well is a link back to the physical. So you can not only fractionalize a bar, but you can do it in lowest usual denomination is 1/10 of a gram. And you can actually allow investors to take delivery of 1/10 of a gram if they want that. There'll be a cost associated with that, but some people do. So it increases access, but tokenization is having an impact in 2 other ways. It's also bringing visibility to the supply chain. So major focus of the World Gold Council is looking at responsible sourcing and making sure that the gold that is produced, the gold that is processed, traded, and then retailed has been responsibly produced in terms of its provenance and its origin. And tokenization is essentially creating a digital twin of the physical asset, and it can give much greater comfort that the underlying asset has been responsibly sourced, because you can provide a record and a visible record of the trading and production history of gold. The third way tokenization is having an impact is on transformation of how gold is traded. Gold is traded in the futures markets, but also the OTC markets in London in particular play a large role in how gold is traded. It's quite an archaic trading mechanism, and tokenization and digitalization is bringing about potentially real-time settlement and efficiencies when it comes to clearing and so on. So there's transformations across 3 areas really. So tokenization is certainly a very exciting time for the gold industry.
Perfect. Yeah, please do.
One, I agree with Michael and Andrew about fractional gold because of what we have seen in Egypt, and we like to call it democratization of gold. So as allowing gold to as many people as you can and help them to use it as a tool through fractional gold, you cannot do that without the digital gold, and it's very successful. And we can see the results. It's extremely successful.
Lee, just wondering at QMB, is that something you're looking at in terms of digitalization of assets and tokenization, or is that off the roadmap at the moment?
It's not our typical way of accessing gold at the moment. We're relatively traditional in terms of the way we're accessing gold for clients. We have looked at in the past gold and gold products. And I think getting some of those things, maybe the regulations are still sort of quite early in the sort of regulatory sort of cycle for that. That's something which hopefully I think sort of as the region develops there'll be more of, certainly in Qatar.
Perfect, thank you. Another question for you, Lee. So precious metals have received considerable attention from investors and fund managers. Why and how to invest in precious metals? Is it a good time now to invest in precious metals?
It is a good time. So I think as I mentioned earlier, when you're looking at gold as part of your asset allocation, and you're looking at your stocks, bonds, commodities should probably be added to that. I think people have forgotten the commodity part, certainly in recent years. I would say that I would just look at the history. So if we look back at the last 7 or 8 years, back to 2015, 16, gold has outperformed bonds pretty consistently over that period. It has spurts, times where it has dramatic outperformance. It corrects some, but actually if you look at it year over year, over the past 8 years, gold's returned about 9% per year. Whereas actually if you look at bonds, and I'm talking about US bonds here, US bonds have returned nothing. And that's a total return of bonds. That includes the coupon. So actually, for me, when I'm looking at it, precious metals as a diversification tool, I actually think it has a huge amount of value there as a diversification tool to my stock portfolio. So from that perspective, I do like it as a sort of medium long-term theme. In the short term, I think it is very significantly overbought this year. It's had a phenomenal past sort of couple of months. I think gold's up about 13% year to date. Bonds are down 4%. There's quite a big spread there. I'm sure it will correct at some stage. But I would point to the sort of the longer term advantages of allocating to precious metals within a portfolio that actually, both from a correlation and performance perspective, I think it actually provides a pretty decent diversifier to your stock portfolio.
Thank you. Serge, I know you can't give investment outlooks representing an exchange group, but could you reflect on how growth or otherwise in gold compares to like other asset classes on your platform, and also how you might see that developing in the Middle East? That would be quite interesting.
So I can't give investment advice. I work at a platform. We facilitate trading, don't recommend trades. But the growth that we have seen really has been, very simply put, has been a shift in our platform. Now, our platform, if you're not too familiar with it, we offer futures products on a wide variety of asset classes. So that's fixed income or rates, FX, equities, but also we're heavily involved in the energy complex, agriculture, and metals. And I'm not saying that to impress you, but to impress upon you that we're sort of a bit of a harbinger of the broader sort of market ecosystem. And what we have seen, certainly with our market participants across across client segments, but particularly so on the buy side, has been essentially much greater activity within the commodities complex, and that's across all of them. And that has also been seen, particularly here in MENA. And what we've also seen as well is that typically within the retail segment, you have seen generally trading within the equity complex. That's normally where you see a lot of trading happening within the retail segment. We have also seen an even greater shift in access and interest within the commodities complex. And more specifically, gold has played a very important part of that growth narrative. So we see not only a transition globally, from that side, say from financials to commodities, but we've also seen it regionally here, and particularly acute and a very acute change within buy side and retail segments.
Perfect, thank you. Question for you, Andrew. So where to trade precious metals in the region, and what are the main derivatives trading challenges in the region as you see it?
Yeah, it's a good question. I mean, there are a number of different ways to trade, or I'd add to that, invest in gold. I think, we need to make a distinction between an investment in physical gold or an exposure to gold through a derivative product or exposure to gold mining equities. They're very different products. So an exposure to physical gold, you get that sort of safe haven properties, but you also get, there's logistical challenge, and that goes back to the second point of your question. What are the challenges? I think with gold, it's sometimes it's the logistics that have to underpin the flow of the physical metal that are the major challenges. I'd also add to that liquidity, and it's just not just sort of the physical market liquidity, but making sure there's sufficient participation and so on. And another major challenge, and I think this isn't for the region specifically, but globally, is perhaps fragmentation. So you do see lots of new investment products come up, and they do sometimes find it quite hard to cut through. But there are a number of ways of trading and investing in gold. But I think the number one consideration is just understanding the underlying product. Is it a physical product, physically backed, or is it an exposure? And both have roles, so they complement each other. Your hedging products, for example, the producers who are our members, the refiners, they need to hedge, and they would do that through not just through the OTC market, but they would do that through the futures markets as well.
Thank you, Andrew. So, Sameh, we were talking earlier a little bit about the Egyptian perspective. So, coming from Dubai, where I work at the DGCX, we see there is a lot of volume traded through the gold souk market. It's a vibrant, healthy, established OTC market, and it can be sometimes harder to get that moved to a regulated market because there are different specifications and different ways of trading. So how has that grown in Egypt? Any perspective you can share with us there?
Yeah, I think one of the major challenges that we faced when we started our endeavor to turn the gold to a financial asset is the domination of the physical market and the OTC. And the OTC in the physical market is, of course, in Egypt is extremely big. And it is not well regulated. And the question was for us, how do we want to compete with this market? And the answer was, if you try to compete with this market, you will lose. What you need to do is make a need for a new market and shift it step by step. Don't get frustrated that you will not get the volume in the beginning. So what we did is that we started to create a new market, well-regulated, with even self-regulated. We impose on ourselves, working with the regulator directly, and whether it's the stock exchange, whether it's the capital market or the central bank, Of course, in the beginning, you will find yourself there is a resistance from all the stakeholders. It's a new thing. But as it go, it will start working. And then once you did the platform and it start working, you will be surprised that the shift will become gradual. So what we have done, for example, we started with almost 0% of the market, of the gold market in Egypt. Now our platform have 10% of this market in 1 year and a year and a half. This is number one. I think number two is trust. People, once they trust the system, they will come to you. The third thing, and it's more important thing, how could you start creating product for the physical market that attract them? Because the physical market for example, in Egypt, at the OTC, have a lot, like it's huge, but have a lot of problems. What we do is we go and address these problems, and we create for them financial products that can help them. By this we want to move the shift from this physical OTC market to financial institutions and capital market. Once you do this shift and the balance become here, especially liquidity, transparency, and all this stuff, this market will immigrate greatly. Not all the market, of course, but at least you can take 30%, 40%, and this, or 50%, and this will be a huge number. And the other thing is, Egypt import and export a lot of gold. So how can we connect the market with the region and with the global market and create financial products for this? This is the step-by-step approach that we're doing, and it is, until now, it is very successful.
Thank you. Lee, we've talked a lot about gold, obviously. What about some of the other metals like silver? Is that something that your clients are looking at? Any thoughts around that space?
So I think as Andrew alluded to a moment ago, so precious metals, most people focus on gold, but there's silver and platinum and palladium if you go down into some of the sort of smaller precious metals. We've tended to focus very much on gold whenever we're looking at precious metals. Part of that reason has been performance. So if we look at, certainly in recent history, and looking at the last sort of 3 to 5 years or so, gold has tended to, it's the most liquid precious metal, obviously, and the largest by market cap, but it's also tended to be the best performing. So gold has been outperforming silver, it's been outperforming platinum and palladium as well, which I think is probably one of the poorer performing within the four. So that's been very much our focus, is gravitating towards the metal which has been performing best, which also happens to be the most liquid.
Perfect, thank you. Andrew, I think you probably covered that a little bit in your early, but any other thoughts to add to that?
Yeah, I mean, I would just emphasize the precious metals group. I mean, the other precious metals, they do perform very differently, and it goes back to that demand profile. So platinum, palladium in particular, very, very industrial focus. You do get platinum use in jewelry, of course, a little bit of palladium in alloyed form, but they are more dependent on the industrial use case. So in EV, for example, silver as well. Silver's used a lot in solar panel technology and things like that as well. So there's a large industrial use case. One other thing I would point out as well, which makes gold quite unique, is the supply dynamics. So we often focus on demand, but the supply of gold is very, very geographically well diversified. It's mined on every continent in major quantities, except perhaps Europe. There's a little bit of mining in Europe, but not significant. But it's not dependent on any specific jurisdiction, whereas platinum and palladium are. So the supply is concentrated in Russia and in South Africa. That does change the dynamics of those metals. And the final point I would make as well about the uniqueness of gold is the recycling element. So supply of gold will grow at 1.5–2% on average per year. That's mined supply. But demand always historically outstrips supply, and that excess is met through recycling. So you do get that price elasticity when it comes to the recycling component of gold demand. And recycling is about 25% of the annual supply of gold. So all of these components taken together just mean that gold performs very differently, and because it performs differently, it performs quite a unique role in a portfolio.
Thank you, Andrew. Sameh, so we have a room full of representatives from stock exchanges in the region. Is there anything the stock exchanges could be doing to facilitate, encourage investment in such asset classes, alternative asset classes?
In my opinion, the stock exchanges can play a significant role in integrating the gold within the capital market and the economy in general. When you look at what happened, I used to come here to this event since 1999. So we saw all the development. When we started, the challenges for the stock exchanges was to introduce the concept of capital market in the region, and we were in early stages. So we're building the infrastructure, the rules and regulation. But when you look at right now, with this conference, you can see how the development of the capital market stock exchanges in our region came. Now, I think the stock exchanges in the region they need to think, and of course all the stakeholders need to think with them, how could we start introducing new products and alternative investment products and to connect it to the global market and the regional market. I think this is the challenge that they are facing right now, because after a while, the traditional stocks, bonds people will get used to that, and they are not interested as before. I think what we need to think about, and to help the stock exchanges to go to this, building this infrastructure, working with the stakeholders, working to the international players. And I think once we do that, I think the stock exchanges will find new investors coming, and then new products coming, and there is a lot of opportunities in there. I will give you a very small example. When we created the fund, the first fund, 100,000 new customers came to the capital market in 3 months, which is, I think, was unheard of in the capital market in Egypt. So there is opportunity for that, and the stock exchanges can play a significant role and can take the lead, in fact, in this regard.
Perfect, thank you. Andrew, anything to add to that? What can stock exchanges do to help facilitate these trades?
Yeah, I mean, just to go back to the original point about souks, the gold souks are significant commercial venues for gold in the region. I mean, Dubai souk will have 50, 60 tons of gold, which is more than a lot of central banks have as gold reserves. So there's significant commercial venues. And whilst the question was about, would exchange-traded products be able to perhaps displace that? There's certainly complementary, because it's the individuals who are buying gold from the gold souk, but then the retailers in the gold souk, where are they getting their gold? And so sometimes we need to think about those intermediate consumers. And this is where Dubai, DGCX with the spot contract, and there's been spot contracts in other markets around the world. They've been targeted at those sort of intermediate participants in the supply chain. So it's really understanding about the needs across the supply chain, and those needs vary. So the producers, the refiners, the jewelers, they will need hedging products. The end consumer perhaps doesn't. And back to Dr. Sameh's point about the fund in Egypt and the changes that are taking place in there, it's really about integration of all these different participants in the supply chain, across that supply chain, integrating those. And just the final point I would say about the general direction of travel when it comes to the gold investment and market, particularly at the retail level. And that direction of travel is for digital or tokenized products or exchange-traded investment products. So moving away from the old sort of over-the-counter bar and coin investment market. This has a number of benefits because it's moving gold from the informal part of the economy into the formal part of the economy, into the regulated part of the economy, but most importantly for for a lot of governments. Less of an issue in markets like this, but I'm thinking about markets like Vietnam, where there's been current account pressures, Turkey in the past, where the regulators have had a bit of a love-hate relationship with gold. Bringing gold into the financial system is beneficial because it makes it productive. Because the issue with gold is, once you've bought a bar, a coin, or jewelry, it can just sit there, and it's not contributing to the broader economics. But when you bring gold into the banking system, you can do more with it. You can pledge it as collateral, you can use it as working capital for businesses, as they do in Vietnam and in Thailand and so on. So it's about making gold productive, and that has benefits for governments and regulators.
Thank you, Andrew. Probably last question from my side. I'm conscious that people are probably hungry for lunch and may have some Q&A as well. But question for either Serge or Lee or both of you. I mean, we've talked a lot about derivatives. How do you see the knowledge and the trading ability in the region? Do you think that's changing? Do you think there needs to be more work done to encourage more derivatives and futures trading? It'd be just good to hear some perspectives on that.
I think that kind of question fuses a lot of the discussions we've had previously. How do you encourage and increase derivatives trading, right? I think there's a lot that you take a look at across that entire value chain. One is to increase your distribution channel and your channel partners, right, and engage, which is a thing that you were certainly talking about a bit earlier. A second is to ensure that you provide a framework with capital efficiency, right, to allow people to trade very, very efficiently and a very efficient use of capital. You also need to provide, liquidity and transparency to allow people to manage their risk very effectively. It's absolutely critical in terms of that particular piece, and it's one where it's our bread and butter. That's what we spend a lot of time on. And coming back to the digital asset piece, we're certainly heavily involved in that space as well. And if you think about it, the tokenization of assets, gold, it could be certainly one of them. Not only allows to increase market participation, as Andrew talked about, and also reduce sort of friction costs in terms of settlement. It also allows one to facilitate very effective collateral management and T0, essentially, margin calculations. Those things have profound impacts on our industry, right, if that actually comes to fruition, and very interesting impacts. And in fact, you think about how that will impact the execution behavior of market participants. Not only are you broadening the market participants, but you're also changing potentially some of the price action that we're dealing with. So some really interesting applications there that allow you to expand your customer footprint and allow you to increase derivative trading. So I think there's a lot of applications that we can have there. One note I did want to mention to the audience as we're talking about metals, one thing I thought I'd highlight more on the base metal complex we talked a bit about earlier. Although it has some industrial use, we have seen quite a large increase as well in adoption across our client base, and that's in copper. Copper has outperformed aluminium and steel. We've seen a substantial growth in adoption as is part of the energy transition narrative, but there's low supply growth. So that's one certainly that we've noticed some growth in. But I think in terms of the more broader growth, it's those key parameters, I think, that are the key critical to success.
Excellent, thanks, Serge. So, Sameh, maybe just some final thoughts. Do we need gold and precious metals in our investment portfolio? What would you say to that?
I believe that gold and precious metals in general, but gold specifically, have been a very important element in any portfolio. Is in hedging and all the stuff. And it's also, especially when there are crises, gold will help you to that. This was historical, but now I think with all what we're seeing happening in the world, and with all with the inflation, with the status of the world economy, and with the geopolitics, gold will be dominant as an asset that help as a safe haven in the future. It's necessary in any portfolio. This is my opinion.
Andrew, any thoughts on that?
Yeah, I mean, gold has a strategic role to play. We've done a lot of analysis on what the optimal allocation for that would look like. Typically around 8% of a well-diversified portfolio. But I think what the market needs is, we've been talking about gold as a diversifier, but we also need a diverse range of products. So we need futures, we need ETFs, we need physically settled spot contracts, we need an active OTC market, because they serve very, very different investment and trading needs. So if you want to develop the gold market, it's important to have that plurality of products, some exchange traded, some on the OTC market, some that appeal to the retail market. And you'll only get a holistic, well-integrated gold market if you have that plurality of products and plurality of venues for trading it.
Perfect. I think we're probably about out of time now, I think. Sounds about right, doesn't it? Then we are done. Thank you to all the panelists. It was really insightful, some excellent learnings for us all there, so thanks to all of you.